Well, the Fed's dovish pivot has been a tailwind for markets all year, at least it appears, until today. So what's next for investors? What are they to make of this environment? Ed Moya is a market analyst with Oanda, and he joins us now. So, Ed, let's just talk a little bit about today's action, what you're seeing in the market right now. We were all talking earlier about how got a push notification from Yahoo, from Bloomberg about German manufacturing hits a 6-year low. Apparently, that's a big catalyst for markets now. What do you just make of the sell-off we're seeing today after a pretty strong positive reaction to what the Fed said Wednesday?
Very much so. There was a big surprise today. No one was expecting to see Germany have such a terrible print with their PMI reading. And what's really concerning is that everyone thought this was the bottom for Germany. So everyone was in their models, they were pricing in that Germany is going to stabilize over these next couple of months, and now it's a scramble. They're trying to say, okay, well, maybe Europe is a little bit weaker. And when you had such a strong rally in the stock market over the last 3 months, and especially after the middle of this week, we had the Fed's, they cemented dovishness for the rest of the year. It was a perfect opportunity for a strong sell-off. Now, global growth concerns are serious. That could derail the stock market rally. But in the short term, right now, this is, it was ripe for a pullback, and we could see some further pressure here. But nothing has really changed as far as the U.S. economy and the outlook.
So you're not too concerned going into next week that we'll continue to see some weakness? Because when you look at the market today with the Dow down over 400 points, there is obviously a lot of concern out there from Wall Street about the fact that slowing growth over in Europe, another sign that growth is slowing over there, is a big concern for the U.S. markets. But you just think it's more of a short-term type of blip and we'll be okay in the longer term? We should be.
We should be. And there is lots of optimism because we are expecting a trade deal. The trade deal is something that everyone's expectation on when that is going to happen has changed. Most people in Washington think that in the next couple of months, or there are some people that think this is going to go on forever. But once we do get a trade deal, that will open up a lot of doors. It will help Europe. Europe is heavily reliant on China. So if we do start to see a little bit of a stabilization there, then the PBOC they have the freedom to open up their easing. Right now, they have held back on easing because they want to make sure that this trade war is dealt with properly. They don't want to unleash, their bazooka of easing and then Trump say, no, I'm going to be a little bit harder. And then they've already provided, most of their ammunition on what they could do to support their economy. So we're really going to focus on the trade war in the next couple of months. There are other key risks, but right now the upside is still potentially there.
You just mentioned the trade war. Ed, I'm curious what else is on your radar. What are you paying the most attention to right now?
In the short term right now, I am focusing on Brexit. Brexit has been a big headwind for Europe. Europe needs a couple of wins. And right now, they need a transition. They need a Brexit agreement so that way we can just move forward and have the ability to just focus on trade relationships, and the messiness of Brexit will continue for the next several years. But they need a deal done. There's too much uncertainty there. In the U.S., everyone's taking, today the big story, yes, it was the China PMIs, the German PMIs, but it was also that yield curve inversion. So that was a big story.
How concerned are you about that? I mean, we've been talking about some of the statistics about what exactly this means in terms of a possible recession over the next 12 months or over the next 24 months. Where do you peg that?
I feel that this yield inversion that we saw today is going to be more like 1995. So when we saw that happen in 1995, the Fed basically decided to cut. After a strong round of hikes, growth was slowing down. President Clinton had his own special counsel probe going on. U.S. was doing trade wars with Japan, implementing all these tariffs on their automobiles. And we still saw stock market have strong gains following the months after. So yes, the inverting of the curve is a big red flag, recession. It is tough to have economic growth, but we are in a new environment. There's other catalysts that could really provide further optimism. And right now, when we invert the curve, deflationary pressures are really making this happen. So it's not necessarily a run on credit. We will see weakness in the economy, and yes, the stock market will be weaker. But when it's a 10 and a 2-year inversion, that's when I'm more. A little bit more. That triggers the 16 to 18 month, countdown till when we get the recession. But for now, I'm still fairly optimistic.
Just quickly, any areas you like right now?
Well, right now we are seeing a bit of flight to safety. So as you mentioned earlier, the healthcare, utilities, consumer discretionaries, those are more defensive plays. With the way rates are, I would be very skeptical of financials right now. And right now, energy prices have been steadily climbing. But when you take a look at what happens in the summer months, and as U.S. ramps up their production, our President Trump is not going to want to have oil prices get too much higher. I'd be a little concerned on the energy sectors.
All right. Ed Moya, thanks so much.
Thank you.